More than 50% since the start of the year. Our next guest says that Chinese stocks are currently valued very attractively. Let's talk to Darius Kowalczyk, Chief Investment Strategist at CFC Seymour. Darius, good to have you with us. Do you think the sell-off in the Chinese market is finally over?
Well, I wouldn't say that it's over because so much is driven there by sentiment, but fundamentally, clearly the market has overreacted to the downside, similarly to the upside overreaction that we saw last year. Price-earnings ratios, the forward-looking ones for Shanghai Composite right now are 16.1, which is below those for Japan. And given very strong growth outlook in the long term for China, in my mind, they are too low.
So, Darius, it's Rebecca in London here. Where exactly do we
Hi.
get the best value if we are seeing attractive prices? Which sectors or what kind of stocks should we be looking for to capture that?
I think that right now you probably still need to avoid the sectors that are predominantly dependent on export because the global environment is going to deteriorate further. However, I think maybe the financial sector should start looking somewhat attractive given the fact that there will be no further monetary tightening in China this year after inflation concerns are gradually receding.
Darius, Christine here again. You know, we keep hearing of all this economic slowdown, data industrial production yesterday lower than expected. Aren't you not concerned about an economic slowdown in the country?
I think that we should not be too concerned because industrial production data was the only one that disappointed on the downside, and there is very good explanation here. The fact that factories around Beijing and in the neighboring provinces were ordered to shut down some of their activities for the Olympic period. All the other indicators actually beat consensus, showing strong gains in consumer demand, in fixed asset investments and in exports, although exports are not rising as fast as at the beginning of the year. And it seems that the government is really trying to make sure that growth is driven by those fixed asset investments and retail consumption, which should pick up slack from waning external demand. So industrial production data will have to rebound in the fourth quarter because the local consumer is buying and because capital spending also needs to be satisfied by what production has to offer.
And yet we've got this increasingly unpleasant combination, Darius, in the rest of the world of rising inflation and slowing growth in several of the major economies. Surely that will have some impact on the growth potential.
Indeed, China is going to see some slowdown of GDP growth in the second half of the year, mostly because the very sharp deterioration in economic activity in the developed world is putting pressure on Chinese exporters. So slowdown has to happen. We are going for 9.5% year-on-year growth in Chinese GDP in the second half, which is about a percentage point below the first half. But because domestic demand in China is continuing to rise pretty fast, I'm not concerned about an overly dramatic deceleration in the pace of Chinese expansion.
Okay, thanks very much for that today. That was Darius Kowalczyk, Chief Investment Strategist at CFC Seymour. Well, next on Capital